Okay, we're going to talk about the best markets to day trade now. Now, some of this is going to be specific markets. Like in general, crude and currencies are consistently, to me, the best markets to day trade because they have nice, well, in the case of crude, even when it's a two-sided market on a day-to-day basis, it has really nice intraday trends, even when crude is very, very two-sided. And I'll show you here. Let's just look at it. So this is crude, and you can see the last few days have been, we're basically building a wide range bounce here. This is a daily chart. And if I go down in time frame, you can see you have some of these nice sustained swings. This is what you want to see. This is the type of thing you don't see that often in, say, the stock index futures. You see it every day in crude, even if you're in a range from day to day of 150 points or something. Here's a 30-minute chart. And you have the classic setups. Crude follows, quote unquote, follows all the rules. I mean, all the markets do, but crude in particular. If you're patient with crude, you've got areas that are tested. You have areas to the downside that are, are key reference areas, and the market will react at those areas. So your auction market inflection points act the way inflection points act. You get this, something like this. What time did this occur? Yeah, this was right. This was in trading hours. So, and you've got the opportunity to enter crude gracefully. And if you enter crude, you get incredible reward to risk opportunities in crude. You could have entered anywhere in here. And this would have been, now this is a little bit rich for some guys, some traders, but the reward is there, the reward to risk. So this is a $370 initial risk, just as I put it up here on a 30-minute chart. But, it's almost 7 to 1 reward to risk. And that's not unusual in crude. And you can go down the time scale in crude and fine-tune your risks if that's too rich for you. This is a 5-minute chart. Let me go back. Let me find something. All right, here's a setup up here. So this is a balance area, and then this is a balance area, and the market spiked prior to, this was, and crude is a little bit like the stock indices. Before the crude day session opens, a lot of times you'll get movement, so you can trade crude before the pit opens if you're careful and you have structure to do it. And that's another way you can sort of fine-tune your risk in crude. So an entry, if you sold this somewhere in here against this level, like that's $130 of risk, and this is the big contract. I mean, it's hard to take an S&P trade now that doesn't have $130 risk, and sometimes if you have an 8-handle range, the reward to risk is way skewed to a contract like crude when you're day trading. And you get these selling tails to trade against, and talk about the time thing. All right, this was a spike. Well, and then you had this big move down, but the market came back up here, tested it again, and it formed another selling tail. So you have all the auction market artifacts, the selling tails, the buying tails, the minor balance areas, and you have great reward to risk in crude. How many of you day trade crude? I know Troy does. Kim, you do? Ed? Yeah, it's a, Raj, you do. It's a great, it's just an awesome day trading vehicle, I think. I mean, if I can sit here and have the luxury of day trading once in a while, I like to trade crude. Even when it's in on a day-to-day basis, it's very rotational. It merits the expectancy is there. Currencies, are great trading vehicles because you can really dial it up in terms of, if you want a little more, a currency with a little more juice or something in it, you could trade, say, the yen or maybe even the euro. If you want to dial it down a little bit, typically you could trade the dollar index, or you could trade the Canadian or things like that. And currencies tend to consistently honor intraday key reference areas very well. And the other thing about currencies is that you can almost always find one or more of the currencies that are trending, and they tend to trend nicely, and it lasts more than 2 days. So if a market's been down 3 or 4 days, you can have a fairly high level of confidence that that's the side of the market you want to continue to favor. So that's another reason that currencies are, these are defaults for me to look at it if I'm going to day trade: crude and currencies. Other markets, you've got to be more selective, and you've got to be selective in the stock index futures. Otherwise, we'll just get chopped to pieces when they're not ready to move, when they're in this balance area. Copper can be a great market to trade, but it's sort of idiosyncratic. Gold is the same way. It's sort of idiosyncratic in its own. It has its own personality. It can be a good market to trade, but to me, the markets that follow the form sheet of what we try to do most consistently are crude and currencies. These are great markets to focus on initially, especially currencies. Crude, is the only reason I would steer anyone away from crude is because it's a rich contract, and you're not going to be able to take multiple contract losses in crude unless you have a large account. Now, the other thing about best markets to trade, and this gets back to one of the themes that we've talked about, is you want to be an opportunistic trader. You do not want to be a trader that trades one contract in one time frame. And that's something else that's been encouraged in this industry forever. In particular, I want to be an S&P mini trader. Well, that's just foolish, especially the way trading is now: high frequency trading, low volatility, low range. A lot of the range occurs at night quite often, etc. But the fact is, all markets have their day. And this, part of your procedure at night in getting ready to trade should be to go through a dozen or 2 dozen markets and glance through daily charts and see what pops out at you. Identify markets that appear to have mature balance areas. Identify markets that are in the early stages of vertical development. Both of those situations are candidates for day trades, and good day trades. And why? Well, because a market that appears to have a mature balance area, those are the types of markets where you can have that home run day trade if you manage to get in a market and you're day trading it when it begins to transition into vertical development in the larger degree time frame. And then the benefit of identifying markets in the early stages of vertical development, it's not unusual for a market that is just beginning to be in that phase of vertical development. And if it's going to be in vertical development for days or weeks even, then those, the first week or so, the markets can be relentless in a directional manner. And those are great markets to day trade too, because you can go in and use these concepts because it is a robust concept. The market develops on a 5-minute chart the same way it does on a daily chart. And you can use that information along with the fact that in the larger degree time frame, this market is moving vertically. Then I can go in, I can look at the shorter term charts, a 120-minute chart, a 30-minute chart, a 5-minute chart. I can find my entries that define my reward to risk. So there's no shortage of markets to day trade, but you'll make it hard on yourself as a day trader if you only look at just one market. If you only look at the euro, you only look at the S&P, or even if you only look at crude. I mean, if you had to only look at one to day trade, it would probably be crude, but there's no point in doing that. The markets to avoid day trading are markets that, you'll hear me when I'm doing the DBSA saying, I don't see anything here. There are better markets to trade. If a market is down 2 days, it's up 3 days, it's down 3 days, it's up 2 days, it's probably forming some sort of balance. And why make it hard on yourself? If you have to strain to find the opportunity, it's probably not there. And you don't have to do that. If you go through 18 markets and you don't see anything that's tradable, take the day off. But I promise you that if you go through 18 markets, you're going to find 2 or 3 every single night that are better candidates for trading than some of the others. So there's no point in making it hard on yourself and fighting a market, even if it's one that you're comfortable with, quote unquote comfortable with. There's no point in trading the euro if it's not tradable, even if you're comfortable with it. You just don't do it because the opportunity is there. Be careful about leverage. I'm going to talk a little bit more about that later, but it's very, very important. Don't trade contracts that are too rich for your account. Regardless of the reward to risk equation, if you can't afford the risk, you don't take the trade. I don't care if it's 10 to 1. If you can't afford the 1, don't take the trade. Don't find something else to trade. There are plenty of markets. And be careful about day trading markets that are typically thinner than some of the other markets, meat, softs, exotics. Now, these markets also at times can be day traded because, as it's said in the previous slide, all markets have their day. But I'm not going to come in here and expect to day trade cotton or coffee every day. There's no point in it, or lean hogs for that matter.